Hello friends, in this lecture we are going to discuss about the cobweb theory of business cycle. In earlier lecture we are discussed about the innovation theory of business cycle or trade cycle which is propounded by Joseph Schumpeter. And now we are going to discuss about this new theory related to business cycle. The cobweb theorem attempts to explain the regularly recurring cycles in the output and price of the farm products, which is agriculture related products. It is a business cycle theory for relates only to the farming sector of the economy. First of all, we should clear that the cobweb theorem of the business cycle or trade cycle is mainly related to agriculture or farming sector. It is not related to business or industrial sector. The term cobweb theory was first suggested by the Professor Nicholas Kaldor in 1934. After Nicholas Kaldor, the Henry Schultz, Jan Tinbergen, Althus Henus, Italy are explained this theory more expensively. It means the Henry Schultz, Jan Tinbergen, Althus Henus, these four economists are related to cobweb theory. It was so named because the pattern traced by the price and output movement resembled as a cobweb. Hence, this theory is known as a cobweb theory. These are some important assumptions of the cobweb theory. First is the perfect competition in which each producer assumes that the present price will continue and that his own production plans will not affect the market. It means the producer assumes the present price trend will be continued. It will not affect his production in the market. Price is completely a function of the preceding period's supply. It means the present prices of the particular commodity is depends upon the production of earlier years. It is specially related to agriculture sector. Hence, in this theory, it is assumed that the price is completely function of preceding year's supply of the agriculture products. In case of agriculture sector, the production or supply will not be increased immediately because there is the cultivation process. Hence, the price is the function of the production of the agriculture commodities in the preceding year or the earlier year. The commodity concerned is perishable. Here also assume that the which commodity we are going to discuss is the perishable commodity. It is not a durable commodity. Demand for agriculture goods is usually price elastic. It is also assumed that the price elasticity is greater in case of agriculture sector. A low price will mean some farmers go out of business. Also, a low price will discourage the farmer for growing that crop in next year, and higher price give the incentives or leads to the more production. This assumption shows that the theory is particularly applicable to the agriculture product or agriculture sector. Hence, we can say that the cobweb theory is mainly focused on farming or agriculture sector. These are the three diagrams which helps to explain the cobweb theory. There are three types of cobweb. One is the continuous cobweb. This dotted line indicates the continuous cycle of the change in price and change in the quantity of the production. It indicates it is a continuous train within this rectangle. Hence, it is known as a continuous cobweb. This is the divergent cobweb. This indicates the divergent train of the changing price and the supply. And third is the convergent cobweb. convergent cobweb is the particularly opposite direction of the divergent cobweb. The first is the continuous cobweb. If we assume this is the quantity of the production, it means the Q2 is the quantity of the production, but the demand is P3. Hence, the prices will be increased because the supply of this particular commodity is less than the demand for a particular commodity. The increasing prices leads to farmer more production, and accordingly the next year the production will be increased and supply will be increased at this particular level. But in case of this particular point, the supply of the commodity is Q2 but the demand is less, hence the prices will be fallen. When prices will be fallen, it will decrease, it will lead to decrease the production level in next year, hence the production will be again decline at this particular level, that is Q1. Accordingly, the continuous cobweb will be created. This is the continuous cobweb. Next one is the divergent cobweb. Suppose we assume that we are here. In case of this particular point, the demand is higher and the supply of the commodity is lower. Hence, the prices will be increased. Increasing prices will lead to more production or more supply. Hence, the next year the supply will be increased at this level. But in case of this level, the demand will fall. Hence, the prices will again fall. The low prices causes to fall in supply. Hence, this point the supply will be decreased. Again, this particular situation, supply is less and demand is higher. Hence, there will be a rise in price caused to higher demand. This will be increased due to the increasing demand. The increasing demand leads to the more supply in next year. The high supply cause the falls for the next year. Suppose this supply of the particular commodities increase at this level, but in case of this particular point, the demand is too low. Hence, the prices will be fall again, and such type of divergent cobweb will become. This is the divergent cobweb. Third is convergent cobweb. Convergent cobweb indicates, suppose this is the situation. In case of this situation, the lower price cause the fall in supply and the supply will be declined. But in case of this particular point, the demand is higher and supply is lower, hence the prices will be increases. According to this particular theory, the cobweb will be, such type of cobweb will be created in the agriculture sector. This is the convergent fluctuation, this is the continuous fluctuation, and this is the divergent fluctuation. These types of convergent, divergent and continuous cobweb will be happens in the agriculture sector due to the price elasticity and the production system of the agriculture sector. These are the some important points which should be considered for the critical analysis of this particular cobweb theory. This is not strictly a trade cycle theorem, for its concern only the agriculture sector of farming sector. It clearly indicated that the most of the hypotheses or assumptions of this theory are related to agriculture or farming sector. These assumptions are not directly connected with the industrial sector. Hence, the many economists says this is not a business cycle in general. It is a business cycle theory of the agriculture sector. This theory assumes that the output is solely governed by price, but this is not a fact. The fact is that the output particularly of the farm product is determined not only by the price but also another factors. There are the input prices, profit level, availability of input, again the natural conditions. The price is governed by the supply available. This is not a true. Many times the supply of the existing commodity and the expectation also matters. The theory is based on the unsound assumptions that the crop of the farmer plants in the 2021 depends on solely on the price of ruling in the 2020. It is not true. Many times the expected price also leads to more production or less production. Producers' decision with the regard production during the given period depends upon only upon the backward look but also the forward gaze also. This is most important in the business sector. In practice, the shape of the curve is such as make continuous divergence impossible. It means the continued cobweb is not possible in the business sector due to the various changing parameters in the economy. It can also be argued that even the constant type of cobweb cycle would not be continue indefinitely. It means independently the continuous cobweb will not be happen. There may be break, there may be change in the direction. These are the some points which can be considered for the criticism of this cobweb theory. Thank you.